I will wait a couple more minutes to see if anyone else wants to join, but I see we already have 65 participants. Can I please ask everybody to mute their audios, please? So good morning, everybody. With 3 minutes past, I'll just wait 1 more minute to see if anyone else would like to join. I see the number of participants, it's increasing. So bear with me. I will please ask everybody that has not yet done so to mute their computers, please. Okay, I think we can start. Good morning, everybody. Thank you for being here to hear and to discuss about a topic that is really paramount to our companies and to the internal market, which is late payments. My name is Tanya Nunes, and I will be your moderator today. I am a policy and legal officer at DG Grow in the unit responsible for SMEs, and in particular, I deal with the late payment file, so with the late payment directive, which I'm sure most of you, if you're here and have interest in the topic, have already seen. So the late payment directive sets payment terms both for G2B and B2B. For G2B, it's 30 days, except for the health sector, it's 60 days. B2B, 60 calendar days, unless otherwise expressly agreed and not grossly unfair to the creditor. The late payment directive also sets some rules on interest and compensation to basically allow enterprises to claim automatic interest plus a minimum fixed of 40 euros compensations for recovery costs. And also the interest rate, according to the directive, is at least 8 percentage points above the ECB reference. I will, of course, not go into the details, but it is important to know that the situation of late payments and the compliance with these rules is unfortunately not always happening. I mean, again, I will leave the hard numbers to the presentation of the annual report later, but B2B actual payment times is higher than payment terms in all of the member states. And this has a huge impact on companies, and in particular in SMEs, of course, because they have less flexibility. Because late payments and long payments, they threaten liquidity. And basically, companies then have to borrow to bridge the gap until they're getting paid. And this is getting more and more expensive due to the high interest rates we currently face. And it is particularly serious also to SMEs. So the EU Payment Observatory is an essential tool in giving us an overview and in monitoring the situation of late payments in member states. You will see later, it gives us, the reports gave us a very clear and broad overview about what's happening and about whether the late payment directive is being complied with. So I will leave you now the floor to the presentation of the latest reports of the EU Payment Observatory, the annual report 2024, that will now show us the hard numbers and the state of late payments in the EU. So we will be hearing from Cincy Alcidi, Senior Research Fellow and Head of the Economic Policy Unit at CEPS, and Jose Marillian, Senior Consultant at EY Consulting. So thank you very much. I'll give you the floor.
Good morning, everyone, and many thanks, Tanya, for setting the scene. Maybe just a couple of words from my side. So the observatory was set up in 2023. This was an effort to which CEPS and EY participated and supported the Commission to set up the observatory, which materially has become concrete with a website which hosts the observatory. So the main purpose of the observatory is really to monitor the situation of payments, in particular late payments in the EU, but it also is a repository for broad information regarding the regulatory framework, but also initiatives at the level of the member states. We do some analysis, so we produce 4 thematic reports over the last 2 years, and at the end of every year we produce an annual report, which I'm going to present in a moment. One important point is that in the observatory, a key component is the stakeholder forum. This is made of all those who have an interest and a stake in the issue of late payment, and for the observatory is an incredible source of information about recent development, the issues as they appear on the ground, and also many initiatives which are often initiated at that sectoral level, not only at country level. So with this introduction, I would like to start to present the main elements of the annual report. We usually divide it in 2 parts. The first part is really about monitoring of trends and recent developments, which is focused on the data. And then we try to go in depth into more specific issues, which we believe are particularly important. In some cases have been highlighted by the stakeholders or reflect recent development. Next slide, please. So the data for 2023 unfortunately point to a deterioration of payment performance. If we look at one of our key data sources, which is the SAFE survey. SAFE is the survey on access to finance of enterprises, which is conducted jointly by the ECB and the European Commission. It highlights the fact that the percentage of companies indicating that they have faced an issue with late payments over the last 6 months is on a growing trend. I mean, the percentage had increased during 2020 until 2022, so the years of crisis, which is somehow counterintuitive, and now is back basically to the level of 2019. And so while there may be different factors explaining this, one possible explanation is that the fact that during the COVID crisis, but also the energy crisis, governments throughout Europe put in place a lot of support measures, including working capital support to companies which may have helped them with liquidity management. Next slide. Another indicator of the deterioration of payment performance can be taken from Intrum. Intrum is a private company which provides services to companies when it comes to payments. And basically, according to data based on transactions, we see a deterioration in the an increase in the payment period. Sorry, can you go back to the previous one? In the payment period between 2019 and 2023, Interestingly enough, and that as it was mentioned by Tanya, government tend to pay later, so the average payment period of governments is higher than businesses. However, the deterioration that we have observed is mostly for B2B. Next slide, please. Another indicators of which support this, the recent developments in the sense of deterioration is given by the performance across sectors. Now, payments performance can vary enormously across sectors, and sometimes the average may actually hide a very extreme performance. For instance, in the chart, you can see that the retail sector is the one where the percentage of companies facing issues with late payment seems to be the lowest. In fact, in retail, we have the two extreme who really have the best and the worst performer. But broadly speaking, there has been a deterioration between 2022 and 2023. Next slide. Another interesting element in relation to the performance payment is the size of the companies. And basically what we now know as being a clear trend is that the larger the company, the higher the likelihood that it pays later. So in this chart, there are a lot of bars and may be difficult to read, but there is one key for reading, which is the following. If you look at the blue bars and the orange bars, which indicate micro and small companies across the about 20 member states that are covered by this data, you find that the bars are the highest. This is in almost all countries. And these indicate the percentage of payment which take place by the due date. So these are the companies that pay on time, and they are essentially in most countries mostly micro and small companies. So this may be counterintuitive, but as I said, this appears to be a systematic trend. Next slide, please. Now, one of the quite fundamental questions is, if we know that a late payment is an issue, it's not new, it actually is very frequent. One question is, why is this accepted? And basically, according to the interim European payment report, which also conduct a survey of the companies they manage, the main reason for this is that creditors fear to damage client relationship if they were to not to if you want to oppose late payments. We see that the share of companies has been declining for a while, but basically in 2023 has started to grow again, indicating that this remains a crucial issue. And one of the main problems related to this is that when companies accept late payment, they may themselves be in a situation where they are forced to be late in paying because of liquidity issues. And this appeared to be a reality for about 1/3 of the companies that are part of the interim survey. Next slide, please. Now, as I mentioned at the beginning, in addition to the monitoring, every year we focus on a couple of specific issues. And this year, for us, there was quite a lot of interest in understanding the single markets and in particular the cross-border dimension. So we wanted to understand whether the issue of late payments is actually, it doesn't have borders somehow. So it's the same regardless of whether you interact within the same country or cross-border at the EU level. And basically, while it's quite difficult to find data from the SAFE survey, we were able to isolate companies experiencing late payments. which is basically the upper part of this chart, which I will be focusing on. So companies which have experienced late payment, and to look at some of their characteristics, and in particular the extent to which they export. And basically, we found a quite interesting pattern whereby the issue of late payment seems less pronounced for companies which do not export, so they interact only in the domestic market, and for those companies which actually export a lot, so they are much more export-oriented, while the problem seems to be concentrated in those who are in the middle. Now, it's not obvious to find explanation, but one potential one is also based on what we gather from focus groups and also speaking to companies, is that those companies which are very export-oriented and are very used to interact on foreign markets tend to resort to insurance against credit risk in international transactions. This is mostly due to the fact that they may not need payment practices or may not need institutional setting. So this may create somehow a need for an insurance, which of course is it helps to maintain this cross-border dimension, but of course represent a cost for companies. So in this sense, cross-border transaction may be particularly affected by late payments. Next slide. Now, of course, in the context of the single market, this leads to the issue of competitiveness. I mean, we know that now the concept of competitiveness goes well beyond the EU borders, but one important point is really about whether a late payment may hinder competitiveness. And basically, what it emerges from the surveys is that basically quite a substantial part of companies say that when they face late payments, they have more difficulties to expand product and services, but also improve their sustainability. There are quite a lot of hindering factors, so that late payment can be an obstacle to several elements which are important for competitiveness, but this too appears to be the most relevant, even though here we observe some more encouraging trend whereby the role of these elements seems to be declining. Next slide. Now, in relation to competitiveness and the possibility of companies to invest, one other important element is access to financial services. And we already spoke about liquidity, already spoke about the importance of investment. Now, the question is to what extent actually that there is a correlation, between experiencing late payment and possibility to access finance. And basically, what we get from the SAFE survey is that there is a very high positive correlation. So basically, if you focus on the bottom part of these charts, you see that the percentage of companies experiencing problems due to late payments is positively correlated with or increases with those having difficulties in accessing financial services. Now, this is just correlation, so it is difficult to establish causality. We have tried to go deeper into this aspect, and basically what we found is actually a circular effect, whereby the probability of difficulties in accessing finance is higher for those companies which experience late payment. On the other side, the probability of late payment is higher for companies which have difficulty in accessing finance. Next slide, please. Now, maybe the two last points I would like to share with you. So the first one relates to the fact that in the context of the observatory, we have a lot of information, more than 100 matrices actually. What we wanted to do was to try to find a way to condensate or to synthesize this information in a single composite indicator, which could give us a sort of ranking. Now, this has been quite an exercise due to the data limitation and the heterogeneity of data. But this year we resorted to a bit more sophisticated approach, and we managed basically to come up with an indicator where some of the confounding factors have been isolated. So we can explain this later. Those who are interested can read the report. But basically, the indicators really leads to a quite clear ranking of countries. And what we observe is that there are three best payers, if you want. These are Denmark, Germany, and Hungary. These are the countries in the map which have the lighter color, while those who stand as being the worst is Malta, Romania, Portugal, Bulgaria, Greece, so the one which are the darker in the chart. Next slide. Quite interestingly, if we compare the ranking in 2023 and 2022, and this is what you can see in this chart, the ranking has basically not changed at all, like just small variation in the middle one country moving from one position to another. But another point that I want to highlight is that for some of the countries, actually the information is quite limited. And if you see these orange bars very large, it means that actually for those countries, information is very limited, and it becomes very difficult to have an accurate information. And this is particularly the case usually for small countries, but not only. And this leads me really to the last point of my intervention. Can you please go to the next slide? Which is the data. Now, this is an observatory, and information data are clear, are crucial, and unfortunately, this remains a major limitation. If anything, actually, we realized that in 2023, the data on late payment is more limited than the previous years. So instead of going towards more information available, we have less. This is mostly due to the fact that for payments, we have no official statistical data source. So data sources are very heterogeneous and dispersed. And as I showed you, actually, I highlighted the data sources for each of the graph exactly to point to this issue that basically we rely on data which are essentially provided by private companies, which collect information related to their own business. So we depend on this also in terms of data coverage. If they reduce the business or the coverage of the country, also the availability of the data of the observatory will decline. And this is basically what we have experienced in 2023. Basically, we have no more data on performance payments in the Baltic countries. So this is extremely unfortunate. The second point is that when we look at G2B, so when governments are involved, the availability of data is actually not better. If anything, somehow in terms of data of country coverage, is even more limited. In fact, what we have for G2B payments is that for a few countries, Italy, Spain, France, data are actually very detailed and available, but for most of the countries, we have no data at all. And then last but not least is really the data of the lack of proper data comparability. This is somehow the issue that we have been trying to overcome using this composite indicator. But the reality is that these data use a different way of measuring delays in payments. Sometimes are based on transactions, sometimes are based on survey, sometimes they report the data of the debtor, sometimes the perspective of the creditor, which of course leave a lot of room for improvement. And with this, I will leave the floor to Sose. Thank you for your attention.
Thank you, Cinzia. So we also, in the annual report, you will also find a chapter on the drivers of on-time payments. And it is crucial to understand on-time drivers, what drives companies to pay on time. so that we can also develop strategies that encourage those type of payments. The chapter contains a few separate sections. One is on the culture of prompt payments. We have also looked at specific examples from countries and some specific examples from different sectors that can be useful. In terms of sources, we based our findings on desk research and also a focus group consultation that took place last September, where we discussed the issue and asked some questions and tried to understand a bit better the situation on the drivers. And in terms of geographical scope, we cover EU, EEA member states and the UK. Next slide, please. So talking about building a culture of on-time payments, what our research shows is that payment culture plays quite an important role. And it is often seen as key to improving payment performance. And the payment culture is also often connected with and affected by individual company culture. So, for instance, there was a report in the UK where showing that companies see culture as embedded practices, and therefore culture practices of businesses would need to change to improve payment culture overall, and there can be a good correlation there. And we discovered that the prompt payment culture helps to build trust and reputation among suppliers, creditors, and customers. And this reputation for reliability can be a significant competitive advantage and can lead the company to become sort of the customer of the choice. Talking about culture, it's also important to understand the regulatory environment, because the culture itself does not operate in a vacuum. And when looking at the regulatory environment, we find that the lack of an effective enforcement can be a weakness in a legislative framework. And when there is no enforcement, there also can be a fear of damaging relationships without the proper legislative basis and therefore enforcement for it. And it is in light of this that particular sanctions are quite important. So when you have legislation but it is not being imposed, or you would need sanctions that are effective and that are preventive in nature to stop late payments and therefore also to drive on-time payments. What we also find in terms of this is that it is also important to note that legislation and enforcement is only as effective as the intended stakeholders are aware about its existence. So proactive dissemination of information and educational legislative updates can be essential to help to navigate the different legal frameworks. And it is also in this light that the EU Payment Observatory can be helpful, trying to paint a picture of what different measures there are available across different countries. In terms of building a culture of on-time payments, technological factors need also to be taken into account. They're often cited as valuable tools for facilitating on-time payments. And in this light, one particular example is e-invoicing, which can help to reduce late payments, can help to cut administrative costs, and can help to save time also. And in terms of administrative costs, what we see is that there are often issues there are often errors that happen due to administrative issues. So e-invoicing can also help to combat that. However, the issue is that for instance, e-invoicing or any other technological factors do not necessarily change payment behavior automatically. So there needs to be a broader approach to this, and not just that technological factors will automatically lead to a change in payment behavior and will automatically lead to on-time payments. And in light of all this, it is quite important to have to develop credit management education and skills. And this is particularly important for SMEs, as they need to learn how to effectively manage credit, and that is not because it is something that directly can impact cash flow and long-term viability. Next slide, please. As mentioned before, we also looked into some specific examples in countries. Some examples I'm mentioning here are from the UK, Spain, and Poland. Particularly in the UK, we see quite a lot of examples that can be useful. For instance, the UK's prompt payment policy. It was established in 2015, and it said that all the organizations that were in scope had to publish on a quarterly basis the percentages of their invoices that were paid within 5 days and within 30 days. And and a year after, in 2016, they also had to, from 2016, they also had to publish all interests liable under the late payment legislation. Also, the Procurement Act 2023 set out a 30-day payment term for all public procurement contracts. In this way, trying to drive on-time payments also in G2B transactions. Sorry. Then there is an interesting initiative, which is the Prompt Payment Code and the revised version of it, the Fair Payment Code. The Prompt Payment Code was established in 2008. It was directed to the private sector as an initiative attempting to not just drive on-time payments, but generally to change payment culture, because it was a voluntary code, but it is something that companies could also advertise as part of their reputation. And a new Fair Payment Code was launched in the UK in 2024. And through this, the Small Business Commissioner, the next bullet point also, will replace the Prompt Payment Code. And the goal of this new code is to reward businesses for paying suppliers quickly and for treating them fairly. And they have various categories in the code. And in terms of the Good Business Pays campaign and the Fast Payer Awards, the Good Business Pays campaign was launched in 2021. It aims to encourage the largest companies in the UK to fast-track payments to small suppliers and to inject capital into the economy. It publishes late and slow payers watch list with companies who are showing the worst payment performance figures as part of the government's payment practices and performance regulations. And in terms of the Fast Payer Awards, the campaign gives out these awards, and it's an annual accreditation and award that is given to companies that pay their suppliers quickly, so under 30 days, or that pay almost all their invoices within agreed time. A couple of interesting examples were found in Spain. The Permanent Observatory of Late Payment and Payments in the sector of road transport was established in Spain in 2012. And this has been, the road sector has historically in this slide shown significant challenges in terms of proper payment behavior. And in this slide, the observatory is helping to monitor payment behavior and therefore also to drive on-time payments. And the other one to mention is the anonymous complaint box for late payments, which can be quite a useful exercise, particularly for SMEs, as they do not need to fear the damage of relationships. And one example is Poland, where recently legislative amendments took place, and they were intended to create a more favorable environment for creditors, and again, with a particular focus for SMEs. Next slide, please. Talking about sectoral practices driving on-time payments, the road transport sector, again, in Spain should be mentioned, where a lot of different processes have been upgraded, and particularly the one to mention particularly is the effective sanctioning regime, and also another strategy, which is the public naming and shaming strategy. This involves a biannual publication of a list of companies that fail to meet payment deadline. And this is quite useful for also driving on-time payments, because companies would fear the reputation damage. In the retail sector in Spain, since 1996, the payment terms have been specified and depending on the different categories of products. And this also has helped to drive payments on time. And in the construction sector in the UK, the interesting initiative is that construction suppliers for government contracts must in fact pay 95% of invoices within 60 days and must maintain an average payment time of 55 days if they want to bid as suppliers for central government contracts that are over £5 million per year. So they must demonstrate that they have effective payment systems, and this also can help to drive on-time payments as companies would be inclined to do that. I think this is the last slide on here, and I would pass back on to Sabs. Thank you.
Thank you very much, Cynthia and Sosa. This was a really interesting presentation. As you can see, the EU Observatory is very useful because it gives us really a clear view on payment performance being deteriorated. We also heard that large companies pay later, that there's a fear of damaging client relationship. We heard about late payments and cross-borders effect, late payments and competitiveness, access to finance, and also very interesting, the drivers of on-time payments, because we want to change this culture. We heard about national practice, sectoral practices, trust and reputation are also keywords that come up. It has been extremely interesting. Thank you also for the audience for putting their questions on the chat. They have been answered, most of it in writing. I would, if Cynthia or Zoe want to tackle in literally 2 minutes, because we need to go to the discussion about the question on whether creditworthiness assessments may help to fight late payments, and whether it has been studied different payment methods that unfortunately disguise the reality of very long payment terms. But it needs to be really very quickly. I'm sorry.
Very quickly on the first point on creditworthiness and then this relationship between late payment and the possibility of accessing finance. So, I mean, there are two things. So the first point is that, of course, if you are exposed to late payments, you may be able not to fall into the circle of paying late if you have access to finance. But of course, this has a cost because you will have to pay interest rates. Now, one example that came up in speaking to companies is that in SMEs, and which points to the importance of education, is that, for instance, there are cases in which SMEs didn't know that could actually get a loan, a credit from a bank, simply by presenting invoices, even though these were not paid. So there are a lot of factors that come at play all together when it comes to late payments, access to finance, and if you want, education and capability to manage cash flows, which are crucially important for companies. On the point on methods like factoring or confirmation, in one of our previous thematic reports, we tackled some of the issues. So I suggest to go back to these publications, and we can share them again in the chat. Thank you.
Thank you very much, Cynthia. And also, this presentation will also be forwarded to the attendees. Thank you very much, both Cynthia and Zoe. This was extremely interesting. We will go to the discussion. We will have David Caro and Hilary Marsh. David is the president of the European Small Business Alliance. And before that, he was chair of Energy and Environment and chair of EU International Affairs for the UK Federation for Small Businesses. Hilary is the government policy advisor for trade justice and for trade justice transform trade. Hilary has 10 years of experience in research, advocacy, and workers' rights, gender equality, environmental sustainability, focused on the UK fashion industry. So I will now give the floor to David, and then followed by Hilary for their opening statements. I will ask you to be short so that we also have then time for questions. The questions can be written in the Q&A part, and we will try to answer all of them if we can. Please, David.
Thank you, Tanya. SMEs have perennially suffered, and the smaller the business, the most vulnerable to late payment they are, spending more time chasing and worrying about money due and how to cover payments to suppliers. It's always been difficult for these companies and the managers of these companies to have to spend so much time on chasing money rather than concentrating on growing their businesses. It's so vital that on time means on time, as stated in a contract. Knock-on effect of late payment for small businesses rooted in the community. They can close, workers become unemployed, cost to government in unemployment pay, lost taxes, and further closures. This is why it's so vital that we have some protection of these small businesses that drive the payments to being on time. And I think the important part of that is that whatever terms are put in a contract, that those payments are received on time so that business can plan around that. Late payment also has been mentioned in the observatory, affects growth and investment, which is all very important, particularly at the moment when we see stagnant growth. And I think it's important as well to separate out G2B payments as opposed to B2B payments. Government are far more capable of paying on time and making sure that as mentioned in the UK section there, that those payments are on time throughout their supply chain. Much easier for that within government than within the B2B environment. B2B is different in that there are sectoral differences, there are differences in contract and the way things work. For instance, a small business in a supply chain might be supplying their customer every day, and it's impractical to think that payment is in 30 days or 60 days so that they're receiving a payment every day. It's more beneficial and sensible from a cost-effective point of view to have payment maybe 30 days after date of invoice, so that any invoice in January would all be paid in one go on the 1st of March. So this is where there needs to be a certain flexibility. And in some ways, I have a little bit of sympathy with the German point of view that freedom of contract means that. But it has to be certain that freedom of contract is fair and just to the small businesses and not developed under coercion in any sort of way. Now, this is open to discussion, and I think it's with the customer, and I think it's important that the customer pays heed to the requirements of the small business, because it's in nobody's interests for those small businesses to suffer and to not be able to grow. And I also think that at the same time we need to look at bad practice, like requiring discounts for paying on time. I feel that this should be part of the discussion, because there are points where businesses, and particularly in the UK, we've seen it with supermarkets, where it's demanded that there's a discount of 3 or 5% to actually receive your money on a contractual term, which is very unfair. And again, we come back to this problem of small businesses are afraid to stand up to the larger customer because they don't want to risk losing a customer that possibly could be 50, 60, 70% of their business turnover. We come to then, how do we enforce this late payment? And it has been suggested that the payment penalties should be something in the range of 8% over the bank base rate. And we come back to the discussion that has been mentioned many times, is SMEs are adverse to taking legal action or any sort of complaint action against their major customer for fear of losing them. So maybe this should be compulsory on the larger companies to pay. But again, how do we find out whether they're paying and whether they're paying the penalties that they should do? Maybe this should be down to the auditors, and included in an audit of a large company is a requirement of the auditor to report to government as to whether those companies are paying on time or paying the penalties that are due because they haven't paid on time. And maybe this could be looked at as a way of driving that payment forward. And again, it was touched on in the Observatory report, the difficulties of late payments on cross-border trade. Again, SMEs have the problem of how do you enforce something in a legal regime that you're not familiar with? My thought on a way of this would be that if cross-border invoicing was factored, and the factoring companies are responsible for taking legal action against late payment in another country. Many of these factoring countries work cross-border and therefore have a knowledge of the different laws in different countries, and it would be a lot easier for them to act on behalf of their factoring client in taking that action to get late payments sorted early and with the penalties required. At the moment, I don't think I have any more to say. I think I've given enough for people to think of there. Thank you very much.
Many thanks, David. It was very interesting. Indeed, it's also with starting with the very punchy line that the smallest the business, the most vulnerable, and it's very true. I will now give the floor then to Hilary. Thank you very much.
Hi, thank you, and thank you for having me today. So I'm here to speak specifically. I work I'm the government policy advisor at Transform Trade, so working majoritively in the UK policy, but we work closely with the Fair Trade Advocacy Office, who we supported on a 2023 report on fast fashion purchasing practices in the EU. The textile sector has long been recognised for the unequal relation of power between international clothing brands and the manufacturers that supply them. And so this report covered a wide range of unfair trading practices, one of which is late payments and the lengthening of payment terms. And this report looked at, obviously there's a lot of documented around the experience, mainly in global production locations such as Asia, and this report specifically looked at the experience of European manufacturers in Italy, Poland, Romania, and Bulgaria. And we looked at a number of practices, including late payments. Essentially the report reported what we've been observing for a long time, which is the extension of late payment terms and the move from commercial handover of goods to a way of brands and retailers regulating their cash flow and passing that risk down onto the supply chain, which again in Europe is majoritively smaller SME garment manufacturing businesses. So firstly, that extension, just to give a little bit of context, we'd be seeing, and it's obviously probably similar to other industries, in the 2000s, we were seeing reports of sort of 10 days payment term. Pre-corona, that's 30. Now we're looking at 60 to 90, and often, and in the report, seeing reports of 120-day payment terms, and that's after receipt of product. So it's bringing us to the point that it's now less about payment for goods delivered and more about cash flow management. Sometimes we hear reports of sometimes they wait until the garments are even sold before making payments, and sometimes there's been reports, not in this specific one, around seeing how products sold, and then that often there's a change in price depending on how it's sold, and issues like that, including, as David spoke to, discounts at point of payment. What was important to note, and it was interesting from this report, is the difference in payment types that we often see. So we often see letter of credit predominantly used in Asia, banks use to secure the payments and reduce the risk for suppliers, and more predominantly in Europe, cash against documents, which is more case by case and involves trust between the buyer and supplier, and there's more risk there on the supplier side. And so the impacts of this, I'm sorry, I'm trying to get through it quickly. The impacts of all of this that we find are always majoritively on the smaller garment manufacturers affected by these late payments. They'll lower capital, they rely heavily on timely payments to meet their running costs. And what we see is delay in payments leads to delay in wage payments, and reducing in innovation and growth and tech innovation. And often that can translate, not specifically in this report, but we can see it around introduction of environmental practices, that the lack of ability to plan, to then be able to even sometimes products can be bought. So a particular type of generator potentially can be owned, but they're not able to run them because they can't plan their payment thing. That's just one tiny example. But that's the kind of thing that we see, that's that lack of being able to plan, and also leads to risk of business collapse. So in the fashion space, the recommendations we're looking at are an unfair trading practice directive within the EU, following taking the lead from the 2019 agriculture UTP directive. Similar ask within the UK. We had a groceries trading adjudicator, and we're looking to set up a similar piece there, and that would include the setup of a dedicated enforcement strategy, including Regulatory Investigation Authority, which would be able to launch its own investigations and follow up on complaints. Similarly, I won't talk about it now, but I can speak to the points that you got to there on prompt payment policy in the UK. Things that we have, the policies we have in the UK, they aren't the key problem we find is enforcement. Even the prompt payment policy, where brands are supposed to, or retailers and businesses need to report their payment terms. It's the enforcement of even the reporting of that the reporting isn't always consistent, and the enforcement of even checking on whether it happens, let alone whether or not it's within time, is another issue I can speak to a little later. But I'll wrap up there and move to questions.
Thank you very much, Hilary. Very interesting. Again, we hear over and over again the word trust. Also, the fact that this reduces innovation and growth. We need more enforcement, and sometimes also a problem of cash flow management. Thank you very much. You touched upon very interesting points. You can, as I said, introduce your questions in the chat, in the Q&A. There are a couple of ones that I'm not sure Hilary or David would be willing to reply. This is probably more for Cynthia. If there's any research about bad debt rates per country, I am sure there is, but this can probably be answered in writing. Governments a central role to play in enforcing penalties for late payment through a new independent enforcement bodies. Yes, this in some countries this is the case. I don't know if Hilary or David want to tackle one of these questions, but the answer is yes, basically.
I think there should be enforcement by government. It's the only way that can be enforced, whether that's by a commissioner or by government itself. And as I mentioned, maybe one route would be through the financial audit at the end of the year. And that if it's picked up by the auditor, then reported to government, government can force the company to pay and pay the penalties to the small company that they haven't paid on time. And one thing I would add is that the penalties that I mentioned earlier on, 8% over base, I think that shouldn't be a fixed rate. I think that should be a rising rate. So the longer you delay payment, the greater the penalty for not paying that. And I think that everything I have said and looking at freedom of contract is no excuse not to have some form of regulation to make sure that companies do pay on time.
Thank you very much indeed. Regulation is important. I was wondering if Hilary would have also something to add on this, or if you want to develop a bit further on, for example, on the good practices for the fashion industry to prevent, I mean, you've touched upon it already a bit, but if you want to further develop also, taking into account this latest question on the importance of regulation.
Yeah, I'd absolutely agree. I think, our key argument is the need for regulation. What we've seen in the fashion industry specifically is there's been a lot of voluntary work around purchasing practices and fair purchasing practices. And whilst I really commend that, and I think there's a lot of work that's been done in the past 15, 20 years around that, we are still seeing these issues and we're seeing them lengthening and worsening, and they're still consistent, I think. And also we saw them spike during COVID, but that's not the only time they happened. They're happening as well outside of that. And so voluntary it's not working, and we need government regulation. And that's why I spoke to the piece that we're working on, the proposal in the UK for a garment trading adjudicator, and in the EU for unfair trading practices directive. Following in the steps, we've seen it happen in the groceries industry. And what's really interesting that we can see is that the ones that, sorry to speak to a UK example, but the groceries code adjudicator and the companies that come under the groceries code adjudicator, we can see the difference in payment terms between the ones that supply both groceries and also garments. We can see the difference that's now been made between their payment terms for those two industries, and it's really vast. We see it sometimes between, I don't have the numbers exactly to my hand, but it's between 30 to 60, say, or even down to 20 for groceries, and they're still up around the sort of 90, sometimes 120 day for garments. So we can really see that the difference that regulation brings in, and what the adjudicator can achieve. And it's quite useful having that direct comparison between a regulated and non-regulated industry.
Thank you very much, Hilary. It's very interesting. I mean, 120 days it's very long. And I was actually wondering if David also could maybe share his experience on this point, whether you have been seeing a deterioration of payment performance, whether you also see it, David.
Yes, I think where there is a sense of regulation and where there is encouragement to pay on time, and that's backed by enforcement, I think you definitely see an improvement of payment terms. And I think one of the things that we need to bear in mind is if there is delay in payments continually, and a company goes not only doesn't pay then its suppliers but goes into bankruptcy, you see a domino effect then that as I mentioned earlier, you see effect on the community. Small businesses are rooted in their community. You see then effect on employees going on to unemployment benefit, which is a cost to government, a loss of taxes for government. And I think many times government don't see the effect on themselves. They only see effect on a business to business basis. And I think governments need to pay attention to what they can lose out, and therefore the requirement and the driver for bringing in regulation. But I think there is definitely an improvement, as Hilary has said, when you see and you compare an area where there is a regime of regulation to a regime where there isn't regulation.
Yeah, absolutely. Thank you very much. I see also in the chat an interesting comment that there's also a growing problem in Sweden, where more and more customer companies are using intermediaries and brokers for purchases. And in this way, they avoid having to report long payment times, according to the reporting law we have introduced in Sweden. So it's also interesting to see that indeed you are right. Both Hilary and David touched upon this point that it's very important to have regulation, but it's also important to ensure that companies are not avoiding the regulation currently in place.
I think that's very true. I think that a lot of thought has to be given as to, as has been mentioned by Hilary and myself, as to how you do that reporting so that the small business doesn't damage its relationship with its customer. And I think that's where a lot of thought needs to be given as to how that's done. I mentioned one possibility of using an auditor. There are other possibilities, and I think that really needs to be looked at and find a way of doing that that doesn't damage the business relationship that there is. And again, as many small businesses, their major customer probably accounts for over 50% of their business, and this is a real worry and a real determiner by the larger company. Can be used as we would say, an arm twister, not necessarily to pay in time.
Absolutely. And trust seems to be the key word that we found in this discussion here today. Thank you very much to both of you. Thank you also to Cynthia and to Soze. I thank you all for your participation. We have 1 minute left. So I would like to thank all of you to have attended and participated, and also for your very interesting comments. I didn't have time to talk about all of them here at live, but we have been trying to reply to them live and also pinpointing some of the very interesting ones. It was a very interesting discussions. Clearly, we have to do this more often because there's a lot of points to be discussing. I mean, late payments is something that touches upon many different issues, from trust to legislation to obligations or voluntary, and it's a cross-cutting issue that also goes through many sectors. So thank you, Hilary, also for bringing the very different fashion industry to the discussion. I would thank you very much for your time and for your explanations. And I wish you a good day.
Thanks very much.
Thank you.
Thanks very much.
Thank you.
Bye.
Thank you,
Bye-bye.
everybody. Bye-bye.